So today on the podcast, I want to share a few considerations, a few tips for business owners, a few investing tips for business owners, I should say, things that you should consider in a down market. Some of these will be investing tips ubiquitous to any investor, particularly in a taxable account. Others are going to be specific to business owners and are suggestions that I think most businesses ought to consider given the circumstances we're in right now. Now, the first one I want to cover is tax loss harvesting. This is not specific to business owners, but if you have investments in a taxable account and you have unrealized losses, because let's say you invest $100,000, now the market's down by 20% and your investment is down from $100,000 to $80,000, well, you might want to think about harvesting that loss because that's beneficial from a tax perspective long term. Idea number 2 is we want to think about Roth IRA conversions or other means of accelerating income. And so I say this because oftentimes when the markets are down, that happens to coincide with a tough time in the economy. And when the economy is tough, that often results in poor business profitability. So the years that your investment account might be down often coincide in years when business performance is down. So anytime that our income is down, we want to think about filling up those lower tax brackets. Now, the other thing that I want to mention with regard to investment accounts, and this is true for business owners and non-business owners out there, is that sometimes in active mutual funds, active fund managers in down markets are sometimes required to distribute substantial capital gains to shareholders. Last year, 2021, happened to be a big year for capital gains distributions. That made a lot of people really upset. Rebalancing should be a no-brainer, but I'm going to mention it as our fourth investing tip in down markets because it's important. When markets are down, it's likely that that the different asset classes in your portfolio are going to change in value by different amounts. Usually, stocks fall by more than bonds. If you've got a 60% stock, 40% bond portfolio, you might find that after a market correction, now you're down to 50% stocks and 50% bonds because the value of your stocks has fallen. Maybe the value of your bonds has fallen, but not by quite as much. The allocations and the portions of your portfolio will change over time based on the performance of each of these asset classes and the underlying investments in them. So when markets are down, we have a period of volatility. It's a nice opportunity to rebalance and harvest losses simultaneously. One that I wanted to highlight here is it's pretty basic, but when markets are down, it's a good time to put more money to work. So if you're a business owner that has a qualified retirement plan, SEP IRA, simple IRA, 401k, cash balance plan, defined benefit plan, your ability to put money away tax deferred obviously depends on the structure of that plan. And some of these things, you can make your deposits and contributions earlier in the year. Now, because markets are down, that's a pretty darn good time to accelerate those contributions that you might have planned for later in the year. So if you have cash laying around, number one, it might be a good idea to max out your own 401k contribution. Those are the 5 things that I wanted to cover. Some of them are specific to business owners, some of them are not. Just to recap, you think about harvesting losses, you need to be cognizant of the 30-day wash sale rule, although that doesn't apply to cryptocurrency. We should think about accelerating, if your income is down, we should think about accelerating income and revenue and deferring deductions. We should also think about Roth IRA conversions because we can get more securities into the Roth IRA for the same tax bill when the value of those securities are down. We need to be prepared for larger distributions than usual from actively managed mutual funds. So if you have an actively managed mutual fund in a taxable investment account, that's what you need to keep an eye on. If it's in a 401k or an IRA or a Roth, doesn't matter. You don't need to worry about it. We need to think about rebalancing, which can often be done simultaneously with loss harvesting. That's how we do it in our firm. And we want to think about accelerating contributions to your retirement plan. Stocks and bonds are down. The more money you put in now at lower prices, the better your long-term returns are going to be. So that's it for today. I hope this was helpful. Some of it I hope was not redundant from future or previous episodes. Some of these points we've covered in the past, but we haven't covered all of them.